Hello, everyone, and welcome to your Glassnode video report for week 42, 2022. So today we are looking at the spring that is coiled up for some volatility on the horizon. What we are looking at today is a series of metrics that are really showing that Bitcoin has been sitting in a very quiet position when it comes to price performance, and uncharacteristically so. It's basically coiled itself up right into the tip of this triangle that we're currently in. And really, Bitcoin does not sit in these positions for very long. We don't see many of these instances in history. And alongside that, we've got futures open interest hitting all-time highs. So we've got a lot of leverage in the system, and we've also got prices really compressing into a narrow range. We need to find out what may happen. So as I mentioned, we are primed for volatility, and we're seeing this both in realized volatility, meaning the actual price performance, but also in options markets, which are basically pricing in a very, very low degree of implied volatility. And we typically see this before, strangely enough, very, very volatile events. So it's very unlikely for Bitcoin to sit still for long periods of time. We do see a lot of metrics that are really primed and just about ready to go. And the question then is, well, what is the most probable direction? What is the market implications of that? So that's what we're going to try and explore today. We're going to look at things across both derivatives and on-chain markets, and a lot of these things are really approaching a significant decision point. Now, as always, please do give us a share, a comment, and a subscribe, and do let me know in the comments. I am going through all of them, so if you do have any feedback or questions, I'm more than happy to answer in those sections, and I'll run you through some of our new dashboards that we've been rolling out recently, which hopefully will give you guys a bit of a head start when the bull market starts to roll around, trying to identify where that transition point is between the bear. Right, it's been pretty nasty through 2022, but eventually this thing will turn around, and these are trying to give you some tools to actually help identify where that momentum may be starting to shift. Anyway, let's get started. So starting up with our price action, and what we can see is that we are continuing to consolidate, but very, very uncharacteristic of Bitcoin is these very long periods of time. And we've been in this for the majority of September and then into October, so over a month now, basically compressing between about 18.5 and 19,500. So a very, very narrow range for Bitcoin to be trading in. And as I've mentioned in the past, there's been two events where I've seen this happen before in my own experience. The first one was in November 2018, right before we capitulated by 50%. And the other one was in April 2019, just before we went from about 4,000 up to 14,000 in a matter of 3 months. So this thing can go in either direction, and we'll see this actually across a number of metrics from here on. Now, we recently rolled out the realized volatility metrics for our T2 and T3 members. So what we're looking at here is you can kind of think about this like the realized VIX. What is the actual volatility going on within the Bitcoin space? Naturally, we see periods of high volatility during bull markets where you get corrections and major pullbacks, which then rally back to the upside, but also during major capitulation events. Here's the one that we had here in November 2018 that I was talking about, and we will zoom in on this in a second. But what I want to highlight, and actually for those of you who are using Workbench, this particular Workbench has two really neat examples. We try to show off some of the powers of Workbench in these videos. The first one is this light blue line that you can see. And what this is doing is actually modeling the current level. So what's nice about this is it works beautifully with the if statement that we've implemented. So what we can see here is that this blue line, you can see all the points where we've had volatility lower than this. So this is basically saying a very low volatility environment. And the second one is these blue curves. This is the if statement. Now, what this is looking at, I only care about bear markets. So I filtered for only where price is below the 200-day moving average. And then I've also looked for any points in time where the volatility, the realized volatility, is lower than our current zone. So what do we see? We can see at the end of the 2015 bear market, we saw these periods of very, very low volatility. Everybody has left the building. Bitcoin's dead as dead. And we're now at this point in time where it's essentially the period where volatility can be the most expected because it's been squeezed into the head of that triangle and then away it goes. We also see it during particular periods of time before major sell-off. So as I mentioned before, it can really go both directions. So now I want to zoom in on our 2018 market to really assess what was going on back then. So we can see here that we had a series of these very, very low volatility environments, ironically enough, right before a 50% sell-off. So the market often gets quite complacent. Everything, kind of all the juice gets squeezed out, and that particular price range has more or less exhausted itself. Now, as I mentioned, the second time was back here in 2019, right before we broke up from 4,000. Here, everybody thought Bitcoin was going to recover and the bear market was over. We'd found support at 6,000 and we went to 3. Here, everyone thought Bitcoin was going to 1,000, it was all over, and we went to 14. So it shows you that these highly volatile events can really get the crowd offside, and that's what kind of gets us to these points. And you can see here we are flagging up on our current day. So we are in a very, very uncommon situation right now, and it does flag that there's a high probability of volatility on the horizon. Now we're going to start with the on-chain space. And what I want to really convey here is that we're at a decision point. Again, alongside volatility, we can also look at the spending behaviors on-chain. Here I'm looking at the aSOPR metric, which is essentially a spent profit multiple. A value of 1.1 means on average of all the coins that are moving, they're realizing 10% profit. 0.9 means a 10% loss. So what we can see is aSOPR typically acts as a support and resistance level. In a bear, see how we tend to bounce off a value of 1 and then get rejected? We come up, we bounce off. We come up, we bounce off. And during this 2018 period, we compressed all the way into this decision point and then collapsed. And then likewise, in April, we collapsed, we pushed all the way up to this 1 level, broke above, and found support. So the psychology of this is really that in a bear market, people are willing to sell and take whatever exit liquidity is offered at their cost basis. Just get me my money back. I'm out. I've had enough of this Bitcoin thing. In the bull market, it's the exact opposite. People are willing to add back to their position and actually build up and buy the dip on their cost basis. So it tends to act as this oscillator that provides support in a bull and resistance in a bear. Now, in our current market environment, note how we are also compressing back in. We've had a series of rejections over recent weeks and recent months, but this overall compression up towards a break-even point is telling us that even though price is down and sideways and pretty miserable this year, we're seeing that the losses being locked in are reducing. That's starting to indicate a level of seller exhaustion, at least for this current price range. We're seeing that the losses and the people who bought the top and everyone who wants to get out of this market has essentially slowed down to the point where the people in massive loss are out, the people in massive profit are out, and we're essentially talking about just people trading day to day now. So it's really compressing in, and it typically precedes some kind of decision point. So I've got an alert ID here for aSOPR on a 7-day moving average. Breaking above is an important, we have to get above that level before any kind of positive recovery can happen. But what you have to watch out for is these false breaks. So we want to see a break above and it stick the landing. Here, 2019 is a great example. 2020 is a great example where it actually breaks above and sticks the landing, gets a nice retest of support, and then away it goes. Until we get that level, we're kind of heading into this decision point where it really could break down or get some momentum to the upside. So that would be your first signal, is getting up above 1. The next one is, does it actually stick the landing or get rejected back below? Now, the short-term hold of aSOPR is telling us a very, very similar story. So I won't focus too closely on it, but really what this is doing is looking only at the coins that moved in the last 5 months. As we explored last week, people who came in the last 5 months now have a superior cost basis to those who've been sitting through all the volatility, all the ups and downs of the 2021 cycle. So quite remarkably, if you are a brand new to this space, well done, you're actually ahead of the long-term holders. So short-term hold of aSOPR really gives us a much, much cleaner signal. You can actually see these retests and break out to a much, much cleaner level. This is the advantage of our entity adjustment that we do here for our tier 3 members at Glassnode. So there are a lot of advantages to that. And you can see that this too is also compressing in, finding resistance on this level. And the question is, do we break above, hold it, and actually find support? Or is this just going to be another breakdown? So the other metric that we have is looking at the momentum of that short-term hold of aSOPR. So what we're looking at here is basically a ratio between our monthly average and our yearly average of aSOPR. And what this is essentially trying to do is map out these bigger picture trends to try and give us a bit more understanding. You can see here in 2018, this rejection did not have monthly momentum positive relative to the yearly. In other words, short-term holders were locking in larger losses of late than they were compared to their yearly average. So thus, it gives us more of an indication they're probably going to take the exit liquidity where it's given. Now, conversely, here in April, we actually made ground well and truly above into the green zone, saying that short-term holders were realizing more profits than their yearly average. And thus, we had an early indicator before this rally actually came through. We had an early indicator that things were looking a little bit rosier. Now, we can also see that following March 2020, quite early on, before we'd even got back to our prior peak, we had a breakout of this metric into the green. Now, bear in mind, you can also get false signals on this guy as well. So, none of these things are perfect. But what we see is we get this advanced warning, which alongside a aSOPR breakup of 1 would give us a higher degree of confidence. Now, here we are, again, massive compression. We are seeing that this metric is at a decision point. We're getting to the point where we're going to see some kind of breakout of momentum. And if this thing can get up and above 1 and ideally take out some of these highs that we've seen, that would show that we have more profits being realized. And that would be a thumbs up and a good sign. It would be more constructive to see that. You want to see people in this market realizing profits, because otherwise they're not going to tell, nobody tells their friends about all the money that they lost in investment. That's just not really how human psychology works. So if we do get those profits coming back in, you start to get that more attractive investment opportunity, and overall the market can start to recover. But until that point in time, Bitcoin is essentially at this decision point where there's volatility baked into this system. It's ready to go somewhere. And right now, we don't actually have any definitive direction. As useless as that may seem, that is also information. Now, on the long-term holder SOPR, I actually want to highlight this one here. This is the long-term holder spending profit multiple. And what we can basically see here is that note how low this is. This is trading down around 0.55, which means the average long-term holder is locking in 45% losses. I mean, that's pretty brutal, to be honest. Imagine hanging onto your coins for multiple months to years and then still taking an almost 50% cut. It's hard. So what we're seeing down here is that only 3.3% of all trading days, you can see this level, only 3.3% of all days have ever been at a worse profit multiple for long-term holders. This bear market has been seriously severe. It has really, really put all long-term holders to the test. And as we saw last week, their cost base is actually now inferior to those who are just entering the space brand new. So quite a remarkable development. We see that this tends to go on for some time, on the order of a year. We've been down here for roughly 6 to 7 months now. So, we're a good chunk of the way through it, but we have been down here for a period longer. So that could, again, signal that duration element we're talking about over recent weeks. Now, just before I carry on, I just want to give you a bit of a heads up. On the left-hand side in our dashboards menu, so top left, you'll see dashboards. Under our tutorials is a suite of about 6 different dashboards we've got set up. And these are really designed to give people from day one, right? So the first 4, navigating tops and bottoms, on-chain activity, Bitcoin mining, and introduction to supply dynamics, you will be able to access all of this with a free Glassnode account. So these have all been designed using only free metrics. We obviously have a lot more advanced ones within our T2 package, but what we're really trying to show you is just the power of what we can do, not only with the base level metrics, but with Workbench as well, using only T1 metrics. So what this one's really focusing on is trying to find those confluence. The important word here is confluence. You want to see multiple metrics giving you the same signal of deviation from some kind of long-term mean. Now, we have a guide here to help you actually navigate this. So each of those tutorials has a guide associated with it. So it's a suite of different models, different Workbench tools. Some are looking for crossover events. Some are looking for overvalued, undervalued. The Mayer multiple, this is one of those really, really long, very, very simple ratio between price and the 200-day moving average, but very, very statistically significant. It's basically held its ground from way back before Bitcoin even had a trading view ticker. So, we're talking about the 200-day moving average is a very, very popular metric. And the reason why we use this as a training tool essentially is to show you how these concepts work. The same concepts we apply to the Mayer multiple can be applied to many other metrics on-chain, off-chain, and otherwise. Now, the other one I wanted to highlight is lesson 2. This is looking at on-chain activity. I mentioned trying to survive the bear and look for that transition out. On-chain activity is an absolute powerhouse for this. I think it's massively underappreciated what it can do. But what we're looking at here is trying to identify changes in bullish or bearish market structure. I mean, at the very highest level, if more people are using the network, it's probably a good thing. If you keep it at that level and then you take that idea and expand it into the different metrics, you'll be amazed what you can find. So, number of new addresses, it looks like we've got a little bit of upwards momentum, but we really want to get above. You can see this bear market channel. We're grinding higher, but within this lower bound channel. Here's the bull market, stands out like a sore thumb. So what we want to look for is those moments where it starts to accelerate into something that is more long-term bullish. So these are just a very, very small subset or an example of some of these tools. We also give you a bit of a snapshot into where this goes once you start looking into T2 and even T3 metrics. So look, do keep an eye out for these. These tutorials are the best place to get started with Glassnode. And as I mentioned, the first 4 or 5 are actually completely available for our free members. So I do look forward to hearing your comments and what you enjoy and what you find useful out of these particular tool sets. Let's get back to the action. So now I want to jump into the derivative space. And what we're looking for here is how is the futures and options markets pricing things. So much the same as our realized volatility, that was actual price performance, options are currently pricing in an all-time low of near-term volatility. Over the next week, options are expecting the lowest volatility they've ever expected. Now, when was the last time that they did this? Well, it was right at the April all-time high where they thought the market was just going to carry on and everything was dandy. We had a 50% sell-off that followed. We saw it again right before the lunar sell-off. So we saw all of this complacency. Oh, look, we've got these big buyers coming in for Bitcoin. And then we had the lunar collapse and then we had the sell-off down to 20K. So that was, again, another 50% haircut. So we can see that these particular, when the market gets lulled into a sense of complacency, it's quite often a precursor to some kind of serious volatility event. Now, futures volumes have declined back to December 2020 levels, right? Same price, 20,000, this time from the upside, but here we are hovering around as support. Now, this means with this very, very low volume that any kind of deleveraging event could be met with much thinner order books than what we're used to. So it could actually amplify this event if something happens. It's fairly low liquidity, and we're actually seeing this not only in Bitcoin, but across global markets as liquidity gets drained out of the system. So there's just not as much trade volume going on. And if you get some kind of move, that shock absorber just isn't really there. So we could amplify that event. So here's where it gets really interesting. Our BTC denominated futures open interest, and the reason we denominate it in BTC is to remove the influence of coin price, because when a position is opened and it's 0.1 BTC, well, of course, the open interest will change with the value of the coin. So if we remove that, we look at just BTC denomination, we can look for periods of growth and decline in net open interest. And we are here at an all-time high of 633,000 BTC. It's about 80% larger than this stable baseline we've had through all of 2021. And note that this started increasing as Luna collapsed all the way up. Now, we need to really understand what's going on here. How on earth do you get something that is so significant? And you would expect all of these liquidations and deleveraging events and all the rest of it, and yet we're just not seeing it, despite coin prices going down, from 30,000 down to 20,000 and below. So the leverage ratio, if we look at the amount of open interest in futures markets compared to the BTC on exchanges, so that balance held on exchange, it too is ripping to new all-time highs. So what this is, again, is kind of backing up the volume chart. We have a kind of low liquidity environment. So if we did get a deleveraging event, the probability that's going to affect spot markets quite heavily is pretty high. So that gives you a bit of context there. Now, onto some more positive news. We're just trying to deconstruct this idea and work out what's the health of the futures market. Because if you just look at open interest, you'd be forgiven for being terrified. Now, if we look at the actual makeup of the collateral, if we go back to April 2021, so this was really, in my view, the peak of the market. Even though we hit all-time highs over here, I believe the bear market actually started following April 2021. This sell-off kind of started things. Now, back then, we had an all-time high in crypto margin. This means that people were backing their BTC futures position with BTC. So when you get a downside draw, you essentially are liquidating not only is your futures contract going lower, so you get liquidated there, but your collateral loses value. So you can, it amplifies the downside. The blue, on the other hand, which is pushing up to all-time highs, is cash margined or stablecoins, so fiat or stablecoins. Now, this has completely taken over dominance. Back here, crypto margin was 70%, so highly, highly volatile and blew everything up, really. Now we're at 70% or 65% cash margined. Now, cash margined, your collateral stays at the fiat value, so it's not moving around alongside your futures position. It's a much healthier style of margin. So therefore, we don't have the same amplification factors in there, which is overall good news and really shows that market preference towards fiat and stablecoin denominated futures. It's a good sign. It's a healthier form of leverage, although it is still leverage. Now, the same, people were paying over 100% annualized for perpetual swaps and over 50% annualized for 3-month rolling basis. So you can see over here all these positive values. This is true degenerates long, right? These are people who are piling on enormous amounts of leverage with BTC collateral underlying it, betting BTC to go long BTC on huge leverage. And we saw the knock-on effects of that, right? We saw multiple months, 50% drawdown, angry times. Now, we saw a very small amount of that come back here in October, November, but nowhere near as much speculation. Here, an enormous compression. I mean, the yields that we're seeing from futures markets right now in a cash and carry style trade is like 2% at most, 0.5% for a 3-month rolling basis. I mean, considering US treasuries are yielding, almost 4% for short dated ones, this is essentially telling us that there is no yield. There is absolutely no yield. And what it also tells us is that there's very, very little speculation going on. These really feel like hedging positions. We're seeing a lot more sophisticated traders. They're not willing to put BTC to bet on BTC and go degenerate long at the top. These look like more sophisticated institutional style positions. Long-term cash and carry trades. As price falls, they don't really care because their whole position is not sensitive to price. We're seeing it used as a collateral, a hedge. We're seeing Bitcoin being used to hedge other parts of their portfolio. This is more likely what we're seeing. So even though we've got an all-time high in open interest, there's a lot more to the story. It's telling us it may not actually be crazy, degenerates just throwing on 100x long bets. It actually could be a whole lot more sophisticated in the back end. And just to really nail that down and demonstrate this, here's the liquidations that were going on. Now, I've color-coded this based on whether 50% or more were long, is green, or 50% or more were short in terms of the liquidations of red. So you can kind of see whether we're in a long or a short liquidation domain. You can see that for the most part, longs are getting liquidated. But here we are at 0.1% of open interest. So if we look at all the open interest, only 0.1% of it is getting liquidated on any particular point in time, which is quite remarkable. This is basically an all-time low in liquidations. So even though price has fallen by 50% since this thing started measuring, right? So it's up here when we started talking about our leverage shift over. We're talking about prices falling 50%, all-time high in open interest, and yet all-time low in liquidations. This again is providing us that extra bit of evidence that it really feels like this is a more sophisticated trade, more sophisticated capital. Yes, we still have a lot of open interest in there. Yes, we still have a low liquidity environment. And yes, volatility still looks like it's just over the horizon. But it also shows us, much like the Ethereum merge trade we talked about back in, I think it was week 36, these are far more sophisticated actors in this space. And really, it's the maturity of this market. So even in the bear market, we are seeing a degree of maturity stepping in here, which is, it is good to see. It shows that the market is evolving, developing, and more serious capital is taking Bitcoin seriously as an asset. So, this is the evolution that we get to watch of Bitcoin's arc as it happened. So thanks everyone for tuning in. Hopefully you found that session useful. Remember, what we're looking at here is an environment where volatility appears to be on the horizon. So things are getting ready to go. Now, in terms of directional bias, we actually don't have a great deal of signal in either particular direction. We have seen prior instances of this in bear markets go both up and down. What we can be quite sure of is that when it does happen, it's probably going to do so with some gusto. So strap on the seatbelts and we will find out how this plays out. And we'll be keeping an eye on things and obviously give you as much information as we can as we evolve and run our analysis each week. So until the next one, I'll see you then. Cheers.